Okay, good afternoon. Today we will be talking about cap rates, and I'm going to be explaining what cap rates are all about because if you're starting off in real estate investing, or if you're not familiar with the commercial side of real estate investing, chances are you're not really sure what a cap rate is anyway. So if you do have questions about cap rates or real estate investing, or if you've been watching my videos and you're thinking, hey, this real estate investing thing sounds pretty good, I want to start investing in some of Seth's deals, just go over to callseth.com and we can set up a quick 20 or 30 minute chat and see if it might be a good fit for you. So cap rates explained. What is a cap rate? And like I said, if you're involved in real estate investing, you're going to be hearing a lot about cap rates. So a cap rate is just a short form for capitalization rate. That's a big word to spell while talking, but capitalization rate. And all that really means is, for our purposes, let's say you bought a property for all cash. So no financing, strictly cash, $1 million property. If that market cap, so if the cap rate is 5%, that means that for that $1 million property, and you have a million bucks cash in it, you would be earning or be expected to earn 5% on your money. Now, obviously, in real estate investing, we have this amazing thing called leverage, where we're able to put a mortgage on these properties and get financing because the lenders know that real estate, especially multifamily real estate, is the most stable type of real estate. So they actually want to give you money, and that really increases your returns. But if we're just talking about cash, a cap rate, just think in your head, if I paid all cash for this property, I would be getting whatever the cap rate is. So in this case, in this example, it would be 5%. So how do we calculate what a cap rate is? Well, there's a really simple formula we can use for that. So a cap rate equals, so all we do is we take the NOI, so the net operating income of the property. And if you have questions about NOI, go over to callseth.com and we'll set up a quick call. And you divide it by the value of the property. And that's going to give us the cap rate. This is a really important formula to use if you're talking about cap rates. You're going to hear something called a market cap. And a market cap is really a cap rate that all the property owners, all the investors in that particular market, what they are willing to accept in terms of return in exchange for the risk they are taking. So when somebody's talking about market cap, so let's say you take any major city, the market cap may be, let's say, 4.5% or 5%. That's what they're talking about. So that NOI, if we flip this formula around, what we do is, for a property's value, we take the NOI and we divide it by the cap rate to get the value of the property. Because in commercial real estate investing, we don't value properties based on an apples to apples comparison. That's called the comparable approach. It's like, let's say you own a house and then 3 houses on the street, they're all relatively similar, sell for X price. Well, chances are your property is going to be worth X amount. Well, in commercial real estate, and this is the great thing with forcing appreciation, increasing the income, decreasing the expenses, you can make a big impact of the value of your property just based on doing some really good renovations, putting in better operations, better management, increasing those rents, and adding other streams of income. So that is the formula for figuring out the cap rate. And like I said, with cap rates, just think, if I bought this property for all cash, this is my expected return. So cap rates, what do they mean? Well, let's say a cap rate is low. So we're talking, let's say 4-5% right now in today's market. That would be considered, that's a cap rate you would find in a major city, 4 or 5%. Well, what does that mean? Well, that means investors, so property owners, are willing to take a return if they bought that property for all cash of 5%. So that means, number one, they feel that market is stable. It's going to be diverse in terms of employment. There's going to be a wide range of sectors. So it's not going to be all focused on, let's say, oil and gas. There's going to be some tech. There's going to be healthcare. There's going to be public works, that sort of thing. So it's stable, diverse. So in exchange for that security, because real estate, it's all about risk and reward. So in terms of So if I'm a real estate investor and I'm investing in a more stable market, a more diverse job market, employment market, all the in-migration numbers are looking good, the population is growing, property values are going up, I'm willing to take a lesser return, so a lower cap rate, a lower return on my money in exchange for the stability, in exchange for that, in exchange for that diversity. On the other side, let's say the cap rate's higher. So let's say it's maybe let's say 8 cap. So that's going to be much higher than that major city center. Chances are it's going to be less stable. And we're going to have less diversity, so maybe it's a small town, maybe there's one major employer. If that major employer leaves town, everything's going to fall apart. Well, as a real estate investor and property owner, I'm going to want to earn a better return on my money, so better cash flow, in exchange for taking the higher risk of entering a less stable market. So just think to yourself, I've said this a lot, but this is the best way to think about it, especially if you're new. If I bought this property for cash, this is my expected return. So a lower cap rate, it sounds kind of contradictory, but if the cap rate is lower, in that case, your property value is going to be higher. If you increase your NOI, if you have a higher cap rate, that's going to have less of an impact. So I talked about increasing your property value, and if you have questions about this, just head on over to callseth.com, and especially if you want to start investing in some really cool deals. I'm not allowed to speak about them on these live streams. So let's say we are acquiring a property and we want to compress that cap rate. You're going to hear this. So compress the cap rate. And all that means is you're taking one property at a level, doing some renovations, making it a better product, so another investor, another buyer is willing to take less of a return on it because it's going to be more stable for the long term. So let's say we have a B- property. So that property will have, it will need some renovations. Maybe the rents are a little bit under market value. Parking lot needs to get done, all that sort of stuff. We're going to take this type of property and we're going to do renovations and beautify it, do all sorts of things to it, and turn it into, let's say, an A property. So we're taking it from a B- to an A. Now, obviously, I'm just making this up for the example. I'm just going to pull numbers out of the air at this point. So let's say the NOI is $600,000 a year. So how we figure this out is we're going to take $600,000. And then let's say the cap rate here for the B-, let's say people are paying 6%, and at an A, let's say they're paying 5%. So all we do is take our NOI, which is 600,000, we divide it by our cap rate of 6%, and that's going to give us a value of the property of $10 million. And again, I'm just making this up. Now, if we take the same NOI, 600,000, and we take our A property now, so it's beautified, and we've done some improvements of 5%, that's going to be a $2 million difference. So that's going to give us a $12 million valuation. So you can see how the income approach and using cap rates and all of that stuff makes a really big impact on the value of the real estate asset. So that's why when we acquire a property, we're always looking for that value add opportunity, bringing up those rents to market value, adding additional income streams, reducing expenses wherever possible, and compressing those cap rates, so making the property look better, feel better, because the lower we can bring the cap rate and the higher we can bring our NOI, you just saw a $2 million difference in terms of valuation. And of course, the larger you scale, so if you have a 100 unit property, the scale works in your favor. If you have a 300 or 400 unit property, again, this scale works in your favor. And as we know in real estate investing, scale is your friend. So I hope this really answered your questions about cap rates. Just think, if I bought this property for all cash, this would be my expected return. Now, obviously, you are a smart real estate investor and you would be using leverage to really maximize your returns and bump up your returns. So if you have any questions about this, or if you want to start talking about real estate investing, go over to callseth.com and we can have a quick call. It's a video chat so we can see each other face to face. So have a great day and I'll talk to you soon.